Paul's going to be joining in just a minute, and we shall get started. Capital Discussion is not a broker-dealer or investment advisor. The presentation about C is for educational purposes only. We don't know your situation, have no way of knowing your level of risk. We're not making any trade recommendations. The risk of loss trading options is substantial, so please be aware of all risk before placing any trades. Hypothetical, computer-simulated trades are believed to be accurate. However, actual profits may vary due to such factors as liquidity, slippage, and commissions. Okay, we can get rid of that. Interesting market we have, huh, guys? It just keeps going up and up and up. This is the graph that I'll always keep up on one screen. I did end up showing this. I'll keep a bunch of stocks that I'm looking at on the lower level. I'll end up basically keeping the S&P 500, and I'll keep my columns up here. So I'll end up keeping things like the E-minis. It's interesting that we're seeing, and let me come over here all the way to the edge. And it's interesting that we're seeing the E-minis move up somewhat while the Russell is going down. It's something that I'll take a look at is the disparity. Now, I wanted to end up showing you a couple of things. Let's go and take a look at, let's start with the S&P 500. Okay, I'll come over to here. If I take a look at a simple S&P 500, I always take a look at a long-term graph, and then I end up breaking it down. If you remember, this is about 2.5 years old. This Fibonacci, which once we end up coming back and testing it, I will end up deleting this. You can end up seeing the breakaway gaps from February and again from Brexit. Here's the most interesting thing. So if I end up showing you, we end up making new highs. We can end up seeing what's happened here, that we've slowed up just a little bit, but what's most likely to happen here, and I'll go through the different graphs and everything that we're looking at, but what's going to happen, at least from a probability point of view, let me get Paul up here, is that it looks like that we're going to have this grind them up type of market. Where we'll just continue to end up moving up. At least that's what the technicals are saying. We're going to go through some of it. Let me just get Paul promoted here. Okay, I made him a panelist. I wanted to end up going through some rather simple graphs. I haven't shown this one before, so I want you to end up seeing this. But to me, if I was going to look at one single graph, right, one single graph, it would be this, okay? Rather simple, but I wanted you to be able to end up seeing it. Basically, when we're looking at what's going on, most of the stuff is noise, right? And what I've tried to do is keep things as simple as possible, okay, from where I am. And the simplest way to be able to take a look at things is there any move out of a range? I mean, that's really what we're looking for. And when I take a look at that, one of the things is that I like to take a look and seeing, well, are we moving in standard deviations? Okay, because you don't know what the underlyings are. Somebody say, oh, this one's much more volatile than that one in terms of one stock versus another, one index versus another index. Well, how volatile is it normally? You know, you can't say that something's more volatile, okay, or it's a higher level of volatility. And one of the things that we take a look at is you can take a look at where things are in terms of their implied volatility and everything else. But what I'm basically looking at here is for movement. You know, one of the things that you know, I look at, I tend to end up being, you've probably heard of, you know, zero delta traders or flat delta traders. You know, I consider myself a flat gamma trader. Deltas I can deal with, right, because they're constants. Anything that's constant I can end up dealing with. It's when things get dramatically worse. So what I'm looking out for is breakouts that can hurt, okay? And I think that most options traders, if you're a premium collector, you're selling more premium than you're taking in, you usually are going to have to end up facing some type of a gamma challenge if things end up moving. This is a great example, okay? And let's take a look at the SPY, because what I want to do is I want to start to look at the underlyings. Paul,
Jim?
are you on yet? Hey.
Yeah, before you change the graph.
Oh, okay.
You know,
sorry.
That's all right. I just wanted to make note of a time frame. Let me find my mouse
The
and
X.
I'll be
I
back
was
in a
looking at
second.
the XLY when I brought it up, and that's this consumer discretionary. Because one of the things I was going to end up bringing up were the different sectors and the large cap versus the small cap. Did you want to look at discretionary, or should I bring up a different underline, Paul?
No, as you had the SPX, we talk about a grind up.
Yes.
Um, if you could just go back to, looks like October 16th, 2014.
Okay. So I'm looking at 14 over here on this side, and we're going to look at October on the 14th, right? Because here's 16, here's
Yep,
15, here's
that,
14.
that would be the bottom of that dip.
Okay, the bottom of the dip here in October, or the one
Yep,
in
no,
okay,
the bottom on October.
okay.
Because
Let
I
me
think
take a
if
look.
you make that a little bigger, you
There you go.
will find that we ended up going up pretty much nonstop for 30 trading days.
Yeah, if you take a look at this, here's the piece that Paul's talking about. Okay, just this huge, huge run up.
Yep.
Okay, I have on these. Let me get these lines off. But before I do, let me explain what I'm looking at. Okay. Um, I like to end up taking a look at basically where we are in certain periods of time. So, what you're looking at here is a Keltner channel. Okay. What you're looking at on these straight lines, these are linear regression lines. And they're basically a one standard deviation and a two standard deviation channel is what they're actually called, not linear regression, standard deviation channel. If I end up coming over to here, and let me come in and hide them so we can just look at get it to be a little bit wider. Right? And so what I'm going to do is I'm going to end up coming in here and I'm going to say, don't show the plot. And I'm going to come into this one, do the same thing, don't show the plot. Apply. Did I miss it? Oh, it's on each and every one of them. You know what? Well, let me just do this, and then I'll just bring it back up if I need it, because that's going to end up working. Okay. On a Keltner channel, said that was peak Aladdin there for a second. What tends to end up happening is if you break out of a Keltner channel, you tend to end up getting a run. And so once you start breaking the downside, you can see what ends up happening. Same thing. But here's where Paul is talking about. Once we started to end up running up, if you take a look at this, we came from, and I'm looking at the SPX. I'm sorry, I'm looking at the SPY. Let me take a look. I know most people would prefer to end up looking at the SPX. Let me get rid of my drawings here. Okay, and let me come and take a look at that same spot. Okay. Um, bottom, let's call it 1820 up to 2080. That's a pretty big run,
Yeah.
right? I mean, you're
Bulls
looking
were
at,
very happy.
yeah, a very, very happy 100, right? 260-point run. Okay. Difficult, right? Very, very difficult, okay, for some types of trades. I know for me, okay, with my Kevlar, that this is the nastiest type of market, okay, where I end up struggling. And the market, if we get this, grind them up market without any pullback, a couple of things happen here is that many of the large investors will wait for pullbacks to get in. And that's when you see higher lows and higher highs, and you see the stair step going up. There's no stairs here. I mean, this is pretty much a straight shot. And what ends up happening is that as larger money managers, they almost start to panic buy. The market's not going to pull back. I have to end up getting in. And that ends up making things go up even more. When they're done, you do tend to get a little bit of a pullback. But as you see here, it's 2 months. Right. Nearly 2 months that this thing took. It's more than a month, right, Paul? Because if I start over here on October 13th, We're only at October 13th over here. You still have a sideways run to an upward run up until the 5th. So you got another, 6, 7 week run up here, which is a big challenge. It's kind of interesting that we did have the sell off in December. Usually you don't see bigger sell-offs in December, but true to form, okay, we had the rally back up, okay, and we wouldn't spoil, Santa Claus's, trip here. You did see a little bit more volatility, but it was kind of after the fear was taken out. If I end up bringing you up to where we are right now, boy, that kind of looks the same. Once we get above, okay, a Keltner, one of the things that ends up happening, I take a look at is the slope, if you will, of the regression line. Basically, Paul measures things in a much simpler way. He measures distance from a moving average, like distance away from a 200-day moving average. Since that wasn't one of the given trades, and then Paul has written code to end up doing this, I'll take a look at the linear regression slope. And basically, what this is saying is, while the linear regression slope is still going up, things are getting better at a faster rate. Once we start to end up turning over, that doesn't mean that the run is over. No, it doesn't mean that at all. It just means that the rate that we're moving up is slowing up. So it's almost like a second derivative, if you will. And so I take a look at that and saying, how much running do we end up having, and will things start to turn? I thought about this morning, and I wanted to share this with you. Paul, you're a car guy, so I was thinking about car examples. Okay. It's the difference between driving at a constant speed and accelerating. If you're driving at a constant 60 miles an hour and you slam on the brakes, okay, it's going to take you, X number of feet to end up coming to a full stop. But if you're at full acceleration, okay, and your car, big engine, and you're accelerating, and at the moment that you hit 60 miles an hour, you're still accelerating at a very fast pace. If you hit the brakes at that point, Paul, right, is it going to take you longer, the same, or less time to stop? Paul, you unmute. I think Paul's on mute up there. I think he just went off mute.
Yeah, I am on mute. And sorry, I'm trying to do some trades.
Sorry, I didn't mean to interrupt your trading. You heard the question, right, though?
No, I didn't. That's the problem. I can't answer it.
Okay, let me answer the question again. And guys, you can end up typing in the chat if you want. If I want to end up, and I'll use 30 miles an hour. If I'm driving a car at 30 miles an hour, and a constant flat 30 miles an hour, and I hit the brakes as hard as possible, and I got my lock brakes or whatever they're called on. This stuff. I don't. It's going to, let's say it takes you X number of feet before you come to a full stop. However, if you are absolutely flooring it, you're drag racing and you're accelerating, okay, and at the moment that your speed, not your acceleration, your speed hits 30 miles an hour, you hit the brakes at that point. Will it take you longer, the same, or less distance to stop?
Longer.
Of course, right? Think about that, guys. It's going to take longer. So you already understand, okay, and Paul loves to end up joking with me that, oh, he doesn't know math. But you already understand, okay, the effect of a first derivative versus a second derivative. The first derivative is speed, right? That's how fast the market's moving. The second derivative is how fast it's accelerating. So if the acceleration of the market is picking up, okay, or something is picking up, especially if you can end up taking some of the noise out of things, that's a really important factor. Okay, and when I take a look, and I'm going to end up showing you some of the volatility stuff that I had been working on with Paul's help. Thank you, Paul. Well, I'll go through some of the things that I had been looking at, and we'll talk a little bit about Vic Central because they have some of that stuff in here, but they just have speed. They don't have acceleration. They don't have be able to take a look at the history. But this is a chart that I wanted you to be able to end up seeing with a great clarity about what's going on. So this linear regression slope means when it's positive, meaning that we're accelerating here, and we ended up coming back down. If I end up going back to the part that Paul was talking about over here, you can see the exact same thing ended up happening, right? And in some ways, you know what, this ends up being, at least to me, this is at the point where sometimes you'll end up hearing people say the easy money has been made. The acceleration of the linear regression slope is getting steeper and steeper and steeper. We're gaining speed. Okay, here we're basically, so if you want to think about we're definitely moving up, but this is the rate that we're accelerating. We're accelerating faster, 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 faster. Once we stop accelerating at a faster pace, we're still going up. We're still accelerating, but we're accelerating at a much slower rate. So while the speed is going up, the acceleration is slowing down. Does that make sense to you guys? I wanted you to be able to end up seeing that because we're at the point right now where the speed is still going up, okay, but the acceleration, okay, is starting to come down. Okay, so where do we go from here? It's a little bit more difficult to be able to end up seeing, but I wanted to be able to point that out to you. One of the things that I also wanted to end up doing, if I come over to here, let me delete this because I wanted to end up showing you just the two, basically what's happened in the different markets. Let me come over to studies, edit studies. Let me get rid of these things for a second. And let me put in, I want to compare the S&P to the Russell because I want you to see what's happened here. Okay, you know what? I'll leave it this way. I will let one of them be the S&P, and I'll put the Russell up here since that'll be quicker. Okay, you can see longer term, and remember where we are right now. We're going back several years. If I go back just a year to date, you can see what's happened. We started to break away here with the S&P started to move higher than the Russell. But look at what's happened more recently. If I come over to here and if I end up going and taking a look at basically the last year-to-date month. You can end up seeing, and you know what? I have percentages here. What I need to end up doing. Sorry about that. I don't want to show them. They're overlaying them, and I want to end up getting prices. And I forgot, Paul, where that you don't show things as a percentage. I can't find it. Let me bring up my my other graph that I'll show you because I have it here. What I wanted to end up showing you here was basically this is from the election, and these were the different underlyings. And what I'll do on here, I'm also going to end up adding the Russell into this. So let me end up adding studies. Let me put in another compare. And we're doing stock, so let me, instead of an SPX, let me do the IWM. Okay, and let's make this one pink, right? We don't have a pink in here. IWM, okay, good, apply. Okay, that's what I wanted you to see. Basically, here's the election. Okay, and look at what's happened with the small caps. Here's the small caps. What we're looking at, just so that you see, this is a 15-minute chart. Okay, and if I end up doing, and it's going back basically to the election, the day before the election. You can see what's happened with the small caps. Over here, this line was the financials. If you take a look over here, when I'll pull them up so that you can see everything. Oh, let me go to studies. Let me edit studies, and let me put the studies over here because this way it would be easier to see. So if I end up taking a look at the XLF, okay, the XLF, okay, is the white line here, okay, and you can see what's happened, okay, with the white line is that we basically have had a sell-off today, okay. If I take a look at the light green line, okay, I was looking at two things. I was looking at the XLP, which is the consumer staples, okay, and here is the green line, if you will, or the aqua line, and you can end up seeing that we started to catch up. But if you take a look at the utilities, okay, that's the lighter color green line. You can see that there was a very big movement back towards one another. And when I ended up putting on a pairs trade, I was looking at XLP or XLU, right, utilities or staples, against the financials to say that they would be pulled together because there was such a large divergence. However, okay, you notice I didn't say that in small caps. And the reason why I didn't say that in small caps is because it is very likely that if the tax policies of the new administration, if they're going to end up being very U.S. centric to be able to help more business in the United States than internationally, it's a simple fact, right? The Russell 2000 does a lot more of their business within the United States than the S&P 500 does. So therefore, it would only end up meaning that the Russell 2000 of the small caps would have an advantage over the S&P 500. So one very fair trade for a period. I wouldn't put it on because it's already broken out, and I don't know how far it's going to end up extending. But if the tax policies do end up happening, and there is incentives to keep business in the United States, being able to have a pairs trade of long IWM and short SPY is a reasonable trade for a long-term trade. Okay. Would I put it on right now? They're too far apart. If they ended up getting a little bit closer together in tax policies, it's something that would end up having some legs to it over a period of time. Paul, any comments about the different industry groups? Okay, as we've taken a look at them here, or are you still busy trading?
Actually, I got my trade off, so I'm back.
So, any other comments about the trading here and what you end up seeing with the market, or in terms of what I was looking at here was just the different industry groups. I wanted to be able to end up showing the pairs trades that we had looked at and that I had taken off. And I went back into VIX, but I don't want to get to the volatility trades yet, Paul. I'd rather end up any questions or anything you'd like to end up adding to this before we move on.
No, we can move on.
Okay. Let me just do one quick thing. I need to end up saving this grid here. Okay. What I end up doing, and I take a look at this, is that if I end up coming over and I want to end up taking a look at different sectors, what I'll do often is that I'll take a look at what sectors look like either on a daily basis. And, all I did here, and I wanted to be able to end up sharing this because you guys can do this in whatever charting software you end up using. If I come and I take a look at my studies and I edit my studies, all I did was I compared the different sectors in the S&P 500. Okay, it's if you don't know where they are. Okay, let me end up showing you. It's quite simple. If you just coming over here and say sector select spiders. Okay, and you end up coming to the sector supply. There they all are. Okay, there's the industry. It tells you what's going on in each of the industry groups. If you don't like these, if you want to put others in, if there's additional ones you want to end up putting in, there's a bunch of stuff. I just made this really simple. I went to the spiders and I just took all of the select spiders. And what I did was each of those are graphed here. Okay, you can see them all. Okay, if what I want to end up doing is this is on a daily basis, meaning it's a daily chart going back a month. That's basically what I want to see. I want to see what's happened over the last month. I can always end up coming in here and changing my time. So if I wanted to end up coming in and taking a look at, let's say, intraday, what's gone over the last 5 days. Let's take a look at the hourly chart. Okay, I can see where things are. What ends up happening is if you do this on your own, you'll start to end up remembering your colors. Okay, of things are. They're also listed up on top, but you can end up figuring out any of these things. Like for example, these are the industrials, right? I just know that my red is the industrials. It's also up here, right? The XLI. You can see over here the XLF, for example, are the financials. Okay, and they're all listed, and you get a feel for which industries are taking off. Because if you're going to play your stocks or your sectors, it's kind of important to know what's going on, why, and when. Um, if I'll go over real quick the regular technicals that I end up going over. If I take a look at the oscillators, and here's just my comments about why I think that we're going to have this grind 'em up market. I've made the comment to you that the oscillators can live on the ceiling, meaning that they can end up being in, overbought as long as they're not extremely overbought territory for long periods of time. But the MACDs, the stochastics, the RSIs, the Williams percent R, the CCI, everything is moving up. Nothing's showing signs of cracking. Okay. If I end up going over and taking a look at the momentum, okay, you can end up seeing that the ADRX, right, the 80 ADXR, I'm sorry, is starting to move upward again. What this ends up meaning when we're starting to move upward again is that the momentum was getting stronger. The momentum, remember what the ADXR is? It's how strong the market is moving in the direction that it's moving. It's not telling you which direction. The DMI, okay, when you overlay everything, does. This ends up telling me here that since the white line is up near the top, that we're very strong, and you can see how close the white line is towards the top. So the momentum is clearly upward. If you end up taking a look at the DMI oscillator, okay, below this again. Okay, the momentum is clearly upward. There's not a crack in here. It's it was funny. Paul and I were joking. Okay, that if you look over the last 10 or 12 days, if I just highlight this, I needed to send my monitor in for repair because obviously the color red is not working. It's only green is only working. But it is, it's been a little bit ridiculous about how far we've moved up, how quickly. So it is a bit of a challenge. Paul, from the movement, any comments about the overall market? Because I do want to get into, the challenges. I've made it clear the challenges that I face with my Kevlar, but I'd like to get into some of the challenges you face or you see different types of trades facing when you have this grind 'em up type of market.
Well, of course, I'm doing mostly the M3-ish style trade, so I end up, out in the on the end of the diving board most of the time during this kind of boost. But I stopped being a contrarian investor, and this is I'm trading for an up market. We're not done. As far as I can see so far, I haven't seen any signs that we're done.
Yeah, I'm not seeing anything either. Zero. You know. The other thing that I end up taking a look at, and the easy way to end up looking at this, guys, is to look at VixCentral.com. And let me just bring that up on a different screen and bring that over to you. When I take a look at this type of a curve where it ends up being a decline. If I go from right to left, it looks like it's declining and things are getting smaller and smaller and smaller. I'm going to leave the difference between these 2 months out for a second. But here's the way you end up reading this. The difference between month one and month two is 12%. So if I take a look at the difference between how much bigger is 16.350 versus 15.55, it's 12.4% bigger. So your level of contango, where each month you go out, it does go up, meaning if I go from lower left to upper right, each month of the VIX futures is higher and higher and higher, but the percentages get smaller. Okay, to me, Paul, you've heard me talk about this. I call that perfect contango. That's exactly when the markets are running fat, dumb, and happy. Okay, and you're in these grind 'em up markets, and there's not a fear in the world. That's what you end up seeing. Okay, the way I end up looking at it is this. Now, I know that I can go back, okay, and I can take a look at historical prices, and I can keep drawing this, but that's kind of difficult for me to see. Right? I mean, here, let me show you. I can come over to here and I can change the dates, and let's come back to 2016. And let's go to November and over here, and I'll say get prices. And I have multiple prices on here. And what I can do is that I can get the previous day. Oh, you know what? I didn't do this. I guess that's the way I should have done it. Right? And I can look at the previous day, and I can go back and I can overlay these things. And you can see here that they were just overlaid, and here are the dates. And it's kind of hard for me to see specifically what happened here. That's why I look at this. All I have done here, again, I've used that simple compare function, and I look at each of the futures. Okay, really simple to go and find out what the future symbols are. I mean, the VIX futures are very right. It's /VX, a letter for the month. Go and look it up. You can find it on the VIX contracts. But F is January, G is February, H is March. Okay, J is April. After a while, you just kind of end up remembering them. Z is December, and then the last character is the year. So Z6 means December 2016. F7 means January 2017. G means February 2017. And I just color code everything so that the shortest one is green, then yellow, then orange, then red. And so when I take a look at this, I can see what things look like. Very simple. Are things getting better? Are they getting worse? Are they widening? Because here's what ends up happening. And this is kind of, I don't want to call it a fact because I'm sure there'll be, some instances we can end up finding. But if there's not a 99.99% certainty in this, I don't know what there is. If there's fear, okay, the front months will go up more than the back months, with the one exception if there's a fear of an event, okay, like earnings on an individual stock or a U.S. presidential election with very different tax policies from the different candidates, where there's fear that if one wins, the market will go up. If the other wins, the market will go down. What you'll end up seeing is that without that event risk, if it's just fear in the market, you'll end up seeing the shorter term lines crossing the longer term lines. And so when I take a look at what an environment looks like of when can I end up being somewhat bullish versus somewhat bearish, I will end up taking a look at this. And I've done a lot of quantitative work. Paul's helping me with a lot of it, going forward on how I end up looking at these. Now, the white line, okay, I just want to have something to end up putting it against. So what you're looking at here is that this is going to be the front month. Okay, so I can always end up just taking a look at the continuous contract, the VX, and that's what I'll end up taking a look here. But these are the three lines that I'll want to end up looking at, and I have to end up changing them all. It's a pain in the butt. I know it is, okay, for you guys to end up doing this because there's no easy way to be able to end up tracking them and saying, oh, always give me the 1 month out future. Oh, always give me the 2 month out future. But here's the whole thing: they switch. Right, they switch. Okay, when you have the rollover and the front month rolls off, so you're not looking at the same thing if you go back. So that's why I kind of like this chart because going back a few days or a few months, okay, as far back as I want to end up going, I know that the green line over here is always going to be the December 2016 contract. Okay, um, that's that's something that's easy for me to end up going back and taking a look at. You can end up seeing over here. Well, you guys know that this was the election, okay, coming in. But look at when the fear started to end up happening. And oh, by the way, you can go back and you can track these polls. It was amazing. Okay, um, this where everything looked like there was a complete joy. Okay, and everything was great on December 24th. I'm sorry, October 24th. Um, the polls were saying that Hillary's going to end up winning. Everything was going to be the same. The markets don't like change. There was uncertainty around Trump, and so that there was complete joy in the markets, and everything was normalized. You can end up seeing that as the polls, okay, started to end up saying there were issues with, the whole FBI thing that had come out with Director Comey and the emails. There was uncertainty, and you can see that was reflected in the market. So I would rather not guess. Okay, I don't really get involved, and you guys have heard me this. I don't get involved in, caught up in watching the news and me trying to guess. Oh, if this happens and then this happens, that means the market will go up. The market is way smarter than I am. Think about it. This is the collective genius of every major player in the world is telling me where the volatilities are going to end up going. And so I'd rather not try to outsmart the rest of the world. I'd rather let the world tell me what they're thinking and then act off of what they're telling us. I mean, to me, that makes a lot more sense. And so you can end up seeing here that we were in total inversion. Okay, meaning that when I say inversion, we're in a normal situation like this is called contango, and that just means that again from that VIX Central that the short-term options are the short-term VIX is trading at a lower point than the long-term VIX. Remember, this is what we were looking at here, and this is totally normal. Okay, and we call that contango. When we end up having, and I can show you here if I go back to history, and let's go back to the dates that we just were talking about, the 16th, and let's go. We'll start on the 20th. Okay, get prices, do multiple, and you can see here. Now, here's the interesting thing about this. This isn't so smooth, is it? I mean, there's some issues here about where it's not that perfect. It's not that perfect line that we end up seeing. Now, if I end up going out in dates, and I move the dates up. Oh, you know what? Let me go back because I don't have the multiple lines. I thought I did. Okay, there we go. Right, and we start taking a look at what happens here. See how the front month is coming up much more? Okay, this is a clear sign that the markets are starting to end up getting very concerned. Now, here's the whole thing. That line, okay, unless there's some type of fluke accidents, okay, a terrorist attack or something, this line over here is not going to end up one morning we wake up and all of a sudden it's going to end up being the short term month is much taller than the second month or the third month. It also ends up telling you a lot about how deep the fear goes, because if the fear is only between the first and the second month, but not between the second and the third month, that means a lot. Okay, it really does. It tells you that the fear is that there might be a short, sudden drop, but the fear isn't there that it's going to end up lasting for long periods of time. And looking at multiple months ends up giving you a great feel for the direction of the market. Okay. And if I just keep going out here, right, the third, the fourth, if you remember, okay, the third and the fourth were Thursday, right? The third and the fourth were the um, Thursday, I'm sorry, the Monday and the Tuesday of the election. The day before, I'm sorry, the Thursday and the Friday before the election. And then what ended up happening on that Monday, and if you take a look, okay, that's this blue line, everything was dropped. Why? Because Director Comey of the FBI said, no, we're not going to end up pursuing anything, okay, with Hillary, and the polls ended up going back that everything was going to end up being fine. And so it kind of ends up showing you the sentiment of the market. Okay, absolutely key. And I kind of like this. It's a free resource. It's great for those of you that have Thinkorswim or any type of charting software. Um, this kind of ends up giving me a good feel because I can also end up seeing how things end up moving on a constant basis. And I like to take a look at this. There is one other chart that I do want to end up showing you that I look at, and that is I like to track the differences, okay, between the different months. Okay, what's the difference between month one, month two, month three? And on that one, I've also, let me do this on a separate graph. Let me pull this one here. We don't need this one anymore, so let me put it over here. And this is my other term structure. Okay, what we're looking at here, let me pull down the formula so you can see them. Is here, it's the same exact chart, except for I want to look at things, okay, the way, the history that Vic Central did. So all I'm doing is that I'm subtracting January from December. I'm subtracting, these are the futures, right? So it's the January VIX future 2017 minus the December 2016 future. And that line is going to end, same color code, right? That's the green line. And so this gives me a better feel for where things are, and it's the difference in the amount. Now I do know you can't end up using just the difference. You really should be dividing it by because it should end up being a percentage. And then if you're going to take a look at these things, you really should end up the math guy's going to tell me, oh, but that's just a difference. That's the speed that things are moving. It's not telling you about the acceleration, and we know that it takes a longer time to stop a car that's accelerating. Well, the same thing here. It's going to take longer to stop, okay, the difference that's accelerating than is just speeding. And so I'll take a look at this. But again, another pain in the butt to end up going. Why? Because every single month I have to end up redoing these things. And sometimes I get lazy. That's why I don't show them to you on a regular basis. But something really, really important. What I've been doing, okay, with Paul's help, is that we've actually been looking at these two graphs, and I'm doing a lot of quantitative analysis behind it, working with a couple of different people. Because here's what it comes down to, I think, is that if I end up looking at just a simple graph of, let's say, XIV, right? I had told my Kevlar guys that I went into XIV a couple of weeks ago. I also did a pairs trade that I was on for a little period of time, but Louis, as some of us call, right? Right, Roman numeral 14. So if you take a look at what's happened, okay, here, because of the rolls, you can end up seeing that there's been a fair push up on the XIV. The easy money was made, okay, because of how far things ended up getting, but there's still a fair bit of roll factor. For some of you, I know are very trade the volatility products a lot, but let me end up explaining to you how the I guess the most liquid one, the one that we talk about most, is the VXX. What this was supposed to end up doing, okay, if you guys don't know the VXX is supposed to try to replicate the VIX. If you're a retail person and you're scared and you're saying, hey, I want to buy a hedge, um, what can I end up doing to end up buying a hedge that's really going to help me? Okay, if the market goes down, the answer is the VXX for a short period of time works great. Notice I said for a short period of time when it's going down. Over a long period of time, okay, it decays. Okay, you can see that this decays. And this is not an algorithmic chart. If I end up, I'll just show you instead of me changing an algorithm, if I end up selecting this, you can also see how this ends up decaying. If I end up coming over to here to say, well, is it continuing to decay? It continues to decay. Now, the challenge that you end up having is that, so I know how to end up making a lot of money. I just keep shorting the VXX and I'll be a millionaire by next Thursday. Here's the problem with that plan. So in 2010, you see this huge drop that we end up having, and you go to end up shorting it. The problem is that if you're wrong, we go from 4,400, 4,500 up to not over 9,000. We more than double, right? We more than double. If you can with handle, having your money be short and losing 100% of the money that you put in a short and still have enough money to come up with a margin call, and you have unlimited money, that's, go at it. I'm a little, it scares the crap out of me. If I take a look at this piece, look at over here. Over here we go from 1,200 up to 3,800. That's more than triple. Okay. And it's more than triple in 4 weeks. You can get absolutely killed shorting the VXX. Okay. Not only that, but because everybody else wants to end up shorting it for periods of time, there's a very big, it's hard to borrow and you'll pay a very high fee. Okay. So the opposite of the VXX is Roman numeral 14, XIV. Okay. Now you notice if I come back here, you don't have the same movement higher. It's not like they're mirror images of one another. Two factors. One is the fact that you have to really look at these things on algorithmic charts on the other one, because if you lose half your value, okay, your move's going to have to be much bigger to end up getting back to even. The other thing that ends up happening is to know how these products work. You can go and find white papers and get all of the technical information you want. What I'm going to try to do is I'm going to end up making this simple, so that I know that I'll probably get emails saying, oh, but Jim, this is the way this works and the way that works. I know, I've read the white papers. I do get it. But to make it simple, okay, if you have a product that needs to be a 30-day, remember, that's what the VIX is, right? A 30-day representation of volatility, and you want to end up doing this with futures, there is no future that remains a constant 30 days out. Each future has an expiration date. So, for example, okay, the December, okay, has an expiration date of 12/20. You can see that. There are 22 days left in this, okay, contract. If you take a look at the January, there are 50 days left in this contract. So if we wanted to have a blended rate that's 30 days, we're going to have a bunch of them that are 22 days and a few of them that are 50 days. But what happens as tomorrow or the next day or the day after that? The simple example that I'll end up giving you is what happens if the front month has 15 days to expiration and the second month has 45 days to expiration? Well, in that case, right, if we take 50% of each, 15 days and 45 days, if we average them, that's 30. Okay, so we just have a 50-50 split between the first 2 months. Well, what happens tomorrow? Well, tomorrow they're going to be not 15 days, they're going to be 14 days. They're not going to be 30 days, they're going to be 29 days. So what that ends up meaning is that we're going to have to sell, because we want to have an average of 30 days, remember. We're going to have to sell some of the front month, those 14 days, and we're going to have to buy some 45 days. So this way, the new average is still 30 days. Is that clear to everybody? I want to end up making sure that you end up getting that fact, because if you don't understand that fact, everything that I go after this is you're not going to follow. Right? Do you understand that it's a moving average and that we have to keep the average of the two futures at 30 days? I'm not getting any yeses. Want me to explain it again? I could give you a different example. Paul, was that clear to you?
Yes, it was.
Okay. Okay, I got a couple of clears. Okay, great. Thank you. So now what ends up happening in normal situations, remember, contango, which means that we going from lower left to upper right, means that every single month, right, if we're in contango, we had to buy a bunch of stuff that was cheaper. Right now, if we did this today, if we had to do this at this point, we'd have to, I'm sorry, sell stuff that was cheaper, not buy. Sell stuff. We'd have to sell stuff at 14.64 and buy stuff at 16.37. So every single day we're going to have a loss, right? This thing is going to end up losing money. Only only when there is fear in the market, like we ended up having when the market thought we were in backwardation when Trump looked like we were going to end up winning, and things ended up switching. Okay, going before the election, and the front month is more. Will it benefit us if we wanted to buy the VXX? Remember what the VXX is? It's just trying to replicate the VIX. So in most instances, what you'll find is that there is this normal decay, except for when there is real fear in the market. And when there's real fear in the market, not only is volatility going up, right? Not only is volatility going up, but also instead of there being this, if you will, this decay or this leakage, okay, in the VXX price, it'll actually turn into an advantage. And that's why when we come back and we take a look at, how violently can the VXX go up, okay, in situations like this, it can go up incredibly violently in a very short period of time. Okay. It's not like it was sudden. If I'm going to come back here and I want to actually show you this, it's easier to show it to you in VIX Central because I'd have to go back and get and I don't keep the charts, by the way. But if I come back and I end up showing you what this ends up meaning, okay, so we're looking here, let's start around July 4th. Okay. July 4th, and this was 2011. I'll come back to history. And I forgot where reset is, so let me just do this. That should do it. Okay. Um, Eli, okay, guy who runs the site, was kind enough to end up showing you the worst day of backwardation history, okay, that he has. October 6th, 2008. If any of you were trading on that day, you were probably under your desk cowering in fear like I was. It was just, this was, we thought that the financial world was going to fall apart. I mean, it was just absolutely horrible. And so you could see every single day, if you sell stuff on this day that goes from, you're selling the stuff at 63.88 and you're buying stuff at 42. This is a huge backwardation. And what would end up happening, volatility is going up, number one. Backwardation is getting steeper. And this is like the bizarro world. Remember I told you perfect, okay, contango before? This is perfect backwardation where they're basically betting that the world's going to end. Okay, and it's going to end quickly. This is remember, by the way, remember what the VIX says. It says that there is a reasonable chance. Reasonable chance, by the way, means a confidence level, one standard deviation, about 68%. They believe that, more than 2/3 of the time that the market, okay, is going to end up moving 63.88% in the next year. That's insanity. I mean, that is just absolute fear at its worst. And you take a look at this, this would end up having a huge factor on the VXX. Now, they didn't have the VXX back then, and all they did was they had models, and you could end up figuring out how to end up running them. And with a bunch of quants that I ended up working with when I was at EAB, we actually ended up having the simulated VXX prices going back to the beginning of history of VIX contracts, futures being traded. Okay, so we could emulate what would have happened. Okay, so we could do a lot more back testing. You have to be able to do that. And the reason why you have to be able to do that is that um, the products have changed. Anybody who ends up telling you about being able to trade or arb these things, be very, very, very careful, because what ended up happening was that before the quant funds knew how these things truly would end up acting over time, they weren't priced properly, and people just made a freaking fortune on this thing. Probably took the quants about 18 months before things got to end up moving the way they were. But the initial VXX products, oh my God, I know guys that made fortunes arbing those things. There is no more arb opportunity here. It's the futures are kind of going to end up predicting those things. I will tell you that the VIX products do have influence over the futures. Usually, it's the futures that always influence the product. Here, there's so much money, okay, from a retail perspective, that's in these volatility products, that there's actually a fair bit of influence in both directions. Okay, so I wanted you to be able to end up seeing that. Okay, and what ended up happening. And so when you end up taking a look at how things could end up moving, there's a really big dramatic move that can end up happening. And you have to take a look over things over short periods of time. You can see this is the run up. By the way, these don't look big. Okay, oh, look at that. Oh, it's a little bump. But what happens if you tried to short this at 30 and it went up to 39? You just lost 30% of your money. That's no small loss. Okay, that's absolutely huge. And so you have to be very careful about the way you end up playing this thing. Are there any questions about this? Because I want to end up telling you, one of the things that I've been doing for a while now, and I'm going to get ready to share it with you guys. I think by the beginning of next year, but I just kind of want to give you a quick little peek. Any other questions about volatility products? Okay, no. So what I've been doing, and I wanted Paul on here because Paul has been, extremely helpful, is that we've been working with a bunch of math quants, and based on quantitative formulas of where different futures are going back several months and the way they tend to end up moving over time, there are indicators, okay, that will end up telling us when I should be long the XIV, and you can see that here, when I should be long the VXX, which is a much, the answer is you usually, very, very infrequently are you going to end up being at VXX, when you should end up being long the VXX for periods of time, okay, that you can end up being without having a huge amount of risk if you are adroit and quick to be able to get in, make your profits, take them, move out, or be in cash. Okay, so there's three possibilities. Okay, of the way I saw this to be able to have a trading system: long volatility, short volatility, or in cash. Long volatility is VXX. Short volatility is XIV. Cash is cash, right? It's no opinion. Um, I try to end up doing this, okay, with futures and vertical spreads and rolls. And the answer is I can end up doing it, but to have this as a service that you guys could try to follow would just be um, orders of magnitude more complex for a few more percent in profitability. And so I kind of scrapped everything some time ago when we were trying to build something with the quants and just made it a lot simpler. Paul and I are finishing up, okay, working with the quants. I'll have something for you probably the beginning of next year, but it'll just be basically a volatility. I didn't know what to call it, so I'm going to be calling it the vol vantage. Okay, trade. Okay, how do I get a vantage? Okay, I want to have some type of a. I could have written advantage, but vantage is also a word, and now I have VV, right? With the vol vantage trade, I will tell you, and I'll let you guys know. Okay, on the survey on the Mondays every week, whether I'm long the XIV I'm long the VXX, or I'm neutral. I told my Kevlar guys a week ago that I am long the XIV. I remain long the XIV. Okay. Um, the key to being in any trading system is you're never going to, and let's just take a look at this year. You're never going to buy the bottom and sell the top. Okay. Forget about that. That is just not going to happen. Okay. I end up telling people who end up looking at that, I say, you have a better chance of getting hit by lightning, okay, on the way to cashing in your $100 million Powerball ticket than you do, picking a bottom and picking a top to get out of. I kind of think if John Pierpont Morgan once said, I've made all of my money buying too high and selling too low. Unless you're richer than John, Pierpont Morgan, give it a shot. Otherwise, try to buy the meat of the curve. And by the meat of the curve, I mean take a run up, stick in it for a while. Once it starts to end up coming down, accept the profits you have and get out. I will end up staying in the XIV, but remember, I need to stay in the XIV, okay, because I'm also, remember, the XIV kind of moves with the market, right? It is a positive beta, meaning that when the market goes up, the XIV will go up. When the market goes down, the XIV will go down. The VXX is the opposite. The VXX states that when the market goes down, the VXX will go up. Okay, and so you can end up trying to trade this. I know a lot of people have done this, and believe me, we did this for a long, long time. We're working out. We already have the formulas and everything is in place. I just have to end up working out the details of how we're going to end up offering this to you guys. But right now, I will end up letting you know. Like I said, every Monday we're long XIV at this point. Paul, any comments that you'd like to end up making on a general basis? Because you and I have spent a fair bit of time looking at this.
No, I think you've pretty much covered everything.
Okay. Any final comments about, or guys, write down any questions that you might end up having. Okay, here. One of the questions is, do I end up pairing my XIV? Personally, right now, what I'm doing is I'm pairing my XIV with my Kevlar. Okay, if I'm long my XIV to be able to end up, and so my Kevlars are down 2 to 4% at this point. I can tell you that my profits from my XIV are more than that at this point, and so I do end up trading them as kind of a hedge towards one another, but not really. Not really. This is just they're standalone trades. It just so happens that when the markets end up moving up in the current environment, these grind them up markets, it makes it particularly challenging for my Kevlar, but it's also easier to end up make money in the XIV because we end up having that roll factor. Right? Remember that roll factor right here is every single day, okay, they have to end up selling the cheaper one and buying the more expensive one. So that roll factor, and this isn't a perfect roll factor, right? It's just the difference between the two. You have to end up doing, how many days. And so there's a lot more math here, but it's a simple way to end up taking a look at it. Okay, guys. I don't see any other questions. Paul, any closing thoughts or comments? Otherwise, we're going to wrap it up.
No, I think we can wrap it up. Sorry,
okay,
but I've been kind of busy.
I know you've been trading. It's this is the problem. Okay, with guys that do short-term trades, it's actually a lot of fun, Paul, because it used to be me who was so busy all the time, and now you would have this extra time, and now that I'm trading longer-term stuff, it's you that's always so busy.
Yeah, right.
Okay, guys, take care. I'll speak to you soon.
Bye-bye.